Donald Trump does a trade deal with the UK that keeps the 10% baseline tariff on most imports. The Bank of England cuts rates, but hawkishly, Malaysia's central bank holds but edges towards a rate cut, and exports from Taiwan and Vietnam jump in April because of front-loading as soon as the US tariff pause started. That's coming up in our 5 Things in 5 Minutes on Friday, May the 9th. And then in our deep dive interview, as part of his analysis of Asian foreign direct investment, ANZ Economist Dhiraj Nim looks at how the China Plus One diversification strategy has affected regional foreign direct investment flows in surprising ways.
It was expected that a lot of supply chain relocation will boost FDI flows into the rest of Asia, but so far, at least it seems that it has played out very selectively.
But first, in 5 and 5 with ANZ, US stocks and the US dollar are rising this morning on news the US has done its first trade deal, and it's with the UK. The 10% baseline tariff on UK imports is staying for most imports, with a few exceptions, including steel, while UK imports of US ethanol are going to have their tariffs taken off. Britain has cut its tariffs, on average, to 1.8% from 5.1%, and it's opening up access to US beef. But of course, the US still has that 10% tariff. ANZ's head of G3 Economics, Bansi Madhavani, says the deal is important because it's the first one since Liberation Day and sets a bit of a template.
Zooming out and thinking about what this US-UK trade deal sets the framework for other negotiations, I think there are a few takeaways to note. The first seems to be that baseline tariffs of 10% are probably a floor. Second, product and sector-specific tariff reliefs seem central to the scope of discussions. Third, we think non-tariff measures such as ease of market access are well within the scope of discussion. And finally, tariff negotiations will be dynamic and ongoing. They do not seem to be, just signed and sealed, but they could be fine-tuned with inclusions and exclusions likely going forward.
US stocks and the US dollar rallied on the trade deal news. As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 1.2%, the Nasdaq up 1.7%, the US 10-year Treasury yield up 9 basis points to 4.37%, and gold was down 2.3% at $3,313 US an ounce. The US dollar index rose 1%, the Aussie dollar fell 0.3% to 64.05 US cents. The Kiwi down quite a bit more, 1% at 59.09 US cents. West Texas Intermediate oil futures rose 3% to $59.87 US a barrel. Number 2. The Bank of England cut its key interest rate by 25 basis points to 4.25% overnight, as expected, but it was a much closer vote than was expected, with a split 5-4 decision. And 2 of the no's wanted a 50 basis point cut, and a surprising 2 wanted no cut at all. Here's Bansi again.
In that sense, the cut delivered today had somewhat of a hawkish tilt to it. Now, what does that mean for future policy moves? Look, our assessment is that the labor market is cooling. Vacancies have fallen, hiring activity has slowed, and supply of labor has risen. Now, we expect this cooling in the labor market to reflect in form of a wage growth slowdown and thereby underpin disinflation. So we have 125 basis point rate cut priced in for third quarter and 225 basis point rate cut in our forecast profile for the fourth quarter.
Number 3. Malaysia's central bank kept its key policy rate on hold at 3% yesterday, as expected. ANZ economist Arindam Chakraborty says the Bank Negara Malaysia, BNM, signalled greater caution on export prospects due to increased global uncertainty.
Regarding the policy stance, BNM emphasized that it is vigilant to downside risks to growth. This was mentioned after a long period, and we think it marks a dovish turn in monetary policy. We therefore continue to forecast a 25 basis point rate cut in the third quarter of 2025.
Number 4. Exports from Taiwan surged 30% in April from a year ago. That was well above expectations for a 16% rise. ANZ head of Asia Research Koon Go says the monthly total of $49.7 billion was the second highest month on record.
Now, what's driving the strong increase in exports is suspected front-loading of products into the US market to take advantage of the current 90-day pause in reciprocal tariffs. So we've seen exports to the US grow by 29.5% in April. And the Ministry of Finance estimates that export growth for the month of May will possibly come in around 15 to 20% year on year. So this front-loading is expected to continue well into this month.
Number 5. Vietnam also saw a boost to exports in April, reflecting that front-loading after the 90-day pause in reciprocal US tariffs. Data this week showed exports rose 19.8% from a year ago, above expectations for a 12% rise. Here's ANZ FX analyst Kasani Basak.
Exports to the US was the major driver. Simultaneously, import growth also surged to 22.9%, boosted by 30.8% growth of Chinese imports. High imports from China will reinforce concerns regarding rerouting of Chinese goods via Vietnam.
Hosani Basak there. Now, in today's deep dive interview, I spoke to ANZ Economist Dhiraj Nim about recent developments in foreign direct investment in Asia, FDI, and asked him how the China Plus One strategy, which saw manufacturers diversify from China, had affected FDI across the region.
I think that, when you look at the broader trend since 2017, 2018, you realize that the China Plus One strategy has not really benefited all economies that we have studied in Asia ex-China as it was meant to. It was expected that a lot of supply chain relocation will boost FDI flows into the rest of Asia. But so far, at least it seems that it has played out very selectively. I think Vietnam has been a clear beneficiary, clocking about 4% net FDI to GDP ratio consistently over the past decade or so, and some isolated instances of benefits in Malaysia and some other economies, for example Apple relocation to India, are the examples. But overall, I do not believe that there has been a meaningful lift in FDI across the region from the China Plus One strategy. Now, there could be various reasons behind it. I think this question is a bit more academic and requires a much deeper empirical inquiry, but if you look at a few data markers, then some potential answers emerge. For example, despite the headwinds that mainland China was facing since the first Trump administration, their global manufacturing and export shares have increased. That could have been due to the fact they were able to manage with trade rerouting, or perhaps the impact of a more competitive yuan on competitiveness of Chinese exports, etc. But the fact that China didn't really lose out much after the first trade war with the US administration is possibly at the heart of the fact that a lot more supply chain relocation did not happen as we had expected. Now, that is also where there is possibly a real second chance for Asia ex-China economies in the region, because this time, of course, we can see that the rift between the US and China has much widened. So we remain cautiously optimistic on this theme to play out more evidently this time than it did the last time.
So overall then, we obviously don't know what is going to happen with those tariff levels both ways between China and the United States in particular, let alone the rest of Asia. But why do you think the foreign direct investment flows in the long run are likely to keep being strong if there is a real downturn, a reversal of globalization?
Look, that I think is the biggest challenge. So if you look at the longer term data, you feel that deglobalization or stagnation in global trade has been at the heart of slowdown in FDI. But we are still optimistic about the medium term potential of Asia ex-China as far as FDI goes. One is, of course, because of what's happening in the global trade currently, where the rest of Asia perhaps will likely move closer to the US and China goes a little farther, as far as economic trade is concerned. We are also optimistic because I think these trade tensions can re-energize the intra-region trade in Asia as large firms in the region switch to regional value creation to mitigate risks from structurally fragmented global order. At the same time, some of the economies in Asia could end up being on more favorable terms with the US than before. For example, India, as the US Secretary said, could be very close to clinching a trade deal with the US and could be amongst the first ones to do so, can sort of give rise to this relatively favorable play as far as exports and investments are concerned in the region. So I think there are several factors to remain cautiously optimistic about. But we have to understand that the FDI flows, their essential character has changed. Their drivers have become far more nuanced. It may not be sufficient any longer to say that if you have a large domestic market or cheap labor, that's enough to get FDI flows. We think that narrative is completely out of the window. In fact, we found that factors like what you export in terms of product specialization and sophistication, your export friendliness in terms of your export infrastructure, laws, etc., and your service export potential actually matters the most for FDI flows in the last 10 years or so. And it all makes sense. Services trade as a share of global GDP has significantly increased over the last decade. It's nearly tripled, whereas goods trade has consistently eased. So, of course, FDI flows will go towards more new age goods, which are technically more advanced, and of course, services. So, economies that can create and nurture ecosystems for these trends, I think, will be attracting much more FDI in the medium term than the ones that can't.
Dhiraj Nim there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 9th. Catch you next week with a look at how China's exports and inflation performed during April. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.